this video, we will be presenting about make or buy decision, or also known as insourcing or outsourcing decision. So in a managerial accounting context, make or buy is a strategic choice between manufacturing a product or component internally or purchasing it from an external supplier. This decision is one of the most common and important decisions faced by managers, especially in manufacturing industries. To understand why this decision matters, let us take a look at some real numbers. Studies have shown that purchased materials and components can account for about 40 to 60% of a manufacturing company's total product cost, while in some industries, this figure can reach as high as 80%. This means that the make or buy decision directly affects a significant portion of a company's cost structure, where a wrong decision can significantly reduce the company's profitability. Historically, many companies followed a vertical integration strategy, which indicates that they preferred to make most components internally. This is because they felt that by making the companies internally, they will have a full control over their operation, which will prevent dependency on external suppliers. However, starting from the 1980s, a shift has occurred, where many companies began to outsource non-core activities to focus on what they did the best. This is one of the reasons why companies like Nike outsource almost all of their production, while companies like Toyota still prefer to make critical components internally. Thus, what are the factors that influence this decision? There are two broad categories that affect this decision-making process, which are the financial and non-financial factors. These factors will be discussed further in the later part of this video. Besides that, make or buy decisions are particularly important for small and medium enterprise since they often have limited capital and cannot afford to make every component internally, while also struggling to find reliable local suppliers. Therefore, the make or buy decision becomes a matter of survival for many Malaysian SMEs.
As my group member has just explained, the make or buy decision is influenced by both financial and non-financial factors. I will now focus specifically on the make side of the equation, discussing 3 factors that justify producing internally, followed by 3 challenges that make this decision risky. The first factor is strategic control over intellectual property. If a company relies on a proprietary technology like a unique chemical formula or custom software algorithm, outsourcing is a massive risk. You are sharing your competitive secrets. By making the product internally, you keep those secrets within your own company. For example, a Malaysian medical device manufacturer will never outsource a life-critical sensor because a supplier could reverse engineer it, patent it, and sell it to a competitor. Here, the make decision is purely defensive. The second factor is idle capacity cost savings. In a factory, machines and floor space represent a fixed cost. You pay for them whether they are running or not. If your production line operates at only 60% capacity, you have a 40% idle hole that you are already paying for. Using that idle capacity to produce a new component internally only adds variable costs such as raw materials, electricity, and operator labor. The fixed cost is already covered by your existing production. This drastically lowers your per unit cost compared to buying from an external supplier who has to charge you for their fixed costs. The third factor is supply chain reliability. Malaysian manufacturers, especially in the semiconductor and automotive sectors, have learned hard lessons from global supply chain disruption. When a flood hits a supplier overseas or a shipping container is delayed, your factory stops working. By making a critical component internally, you control the supply chain. You schedule your production exactly when you need it, and you inspect quality at every stage. Now, let me highlight 3 major challenges of making a product internally. The first challenge is high capital expenditure, also known as CapEx. Making a product internally requires money before you sell a single unit. A single automated production line for a Malaysian electronics manufacturer can cost between 2 million and 5 billion ringgit. This creates a high break-even point. If demand drops unexpectedly, You are stuck with expensive machines, loan repayment, and depreciation will eat your profits. Many Malaysian SMEs have gone bankrupt because they invested too heavily in making a component only to see the market collapse. The second challenge is a lack of internal expertise. A company might excel at design and marketing, but fail at manufacturing. Finding skilled technicians, engineers, and machine operators in Malaysia is difficult. Even if you have the money to buy the machine, you may not have the people to run it and maintain it. Relying on trial and error can cost millions in wasted materials and broken equipment. The third and most subtle challenge is strategy inflexibility, also known as technology lock-in. Imagine you invest heavily to make a specific type of circuit board. 2 years later, a new and more efficient technology emerges. Your competitor who buys their circuit boards can switch suppliers overnight and adopt the new technology immediately. You are stuck with your old production line because you cannot easily replace it. Your make decision has locked you into obsolete technology. To support these points, I reviewed some journal articles on Malaysian manufacturing. The literature consistently shows three things. First, most manufacturers choose to make primarily to protect proprietary secrets, not just to save their money. Second, utilizing idle capacity cuts costs by up to 25%, but only if the factory operates above 70% capacity. Third, a lack of skilled technicians and the risk of technology lock-in are the biggest reasons for failure. This confirms the make decision is strategic, not just financial.
Now, let us look at the side of buy decision. There are several factors that explain why a company might choose to purchase a component from an external supplier instead of producing it internally. The first factor is to reduce the operation and overhead costs. Companies can save on direct labor costs, machine maintenance costs, and high factory overhead costs by outsourcing certain production processes to external suppliers who have a better economy scale. The other factor is to improve the company focus. Through outsourcing, management and internal staff can focus fully on the company's core business and capabilities as well as key activities such as product design, marketing, or rebranding for competitive advantage. Next, company also decided to buy since there are unavailability of internal resources. Well, buying is a good option when a company does not have the latest technology, specialized expertise, or sufficient machine capacity in its own factory to produce components to a high standard. However, of course, there would be pros and cons when we decided on something. You know what? There are several challenges and risks on buy decision. What are those? Let's see. The main challenges is quality control issues where companies may face the risk of receiving components that do not meet the specific specification or are defective since the production process is carried out by a third party and is difficult to monitor directly by the company. Next, there are supply chain and delivery risks that company may face. For such, any logistical problems or failure of suppliers to deliver goods on time can affect the company's entire installation schedule and operations. Other than that, company also may rely too much on the suppliers, which excessive dependence on suppliers can lead to increase in bargaining power, which could expose the company to the risk of sudden increase in raw material price in future. So, the conclusion is the decisions and choice to buy requires a thorough assessment not only from a cost perspective but also from a supplier risk management perspective.
Now that we have examined both making by size, let us look at the actual decision-making process. This decision is very important because it directly affects the production cost, profitability, efficiency, and also the overall performance of the company. There are four main steps involved in this process. The first step is analyze the problem, which is whether the company should make the product internally or buy externally from a supplier. At this stage, management needs to clearly understand the situation faced by the company. For example, the company may experience increasing production costs, lack of production capacity, shortage of workers, or better prices from the suppliers. Therefore, the management must analyze whether the producing internally is still beneficial or whether purchasing from external supplier would be a better option. For the second step, the company identifies all relevant costs and benefits involved in both alternatives. Cost to make refers to the cost incurred if the company decides to produce the product internally, such as direct material, direct labor, and also production overhead costs. Cost to buy refers to the amount paid to the external supplier to purchase the product or company. The company also should consider opportunity costs and also incremental costs, in which are classified as relevant costs. Lastly, avoidable feed cost refers to the feed cost that can be eliminated if the company chooses not to produce the product internally. The third step in the process is to compare alternatives between cost to make and cost to buy. At this stage, management compares all relevant costs and benefits identified earlier in the second step. The company will calculate the total relevant cost for making internally and compare it with the total relevant cost for buying it externally. Besides comparing the financial process, management also must consider non-financial factors such as product quality, supplier reliability, delivery time, and also the company production capacity. For example, producing internally may provide better quality control and perfect confidential business information, while buying externally may save time and reduce operational burden. Management will then evaluate option provides greater benefits and support to the company's long-term objectives. If the cost to buy lower and the supply is reliable, outsourcing may is the better choice. However, producing internally gives better control, higher quality, or strategic advantages. The company may decide to continue making the product itself. The next step is to decide on the best option, whether to make or buy. After analyzing and comparing all relevant information, management will choose the alternative that provides the greatest benefit and supports to the company's objective. If producing internally results in lower cost, better quality, and efficient use of resources, the company will decide to make the product. On the other hand, if purchasing from an external supplier is more cheaper, faster, and more efficient, the company will choose to buy. In conclusion, the make or buy decision is an important process that helps the company choose the most beneficial option for their operation. By identifying problem, analyzing relevant costs and benefits, comparing alternatives, and making the final decision, management can improve efficiency, control costs, and support the company's long-term goals. Therefore, companies must carefully evaluate both financial and non-financial factors before deciding whether to make or buy externally.
Now I'm going to focus on a real-world case study involving a Malaysian organization called Dipro Technology. This case is perfectly illustrate the real-world risk of an outsourcing decision and shows what happens when a company is forced to pivot back to an insourcing strategy. Let's start with the case background. Dipro Technology is a semi-government agency operating under a ministry in Malaysia. Their primary mandate is to provide specialized technical services to private corporations and the public. Because they rely heavily on government funding, they are under strict regulatory pressure. Specifically, Dipro is legally required to submit accurate cash flow statement to their governing ministry every single quarter. To manage this heavy financial workload, Dipro decided to outsource its accounting function to a local external vendor called Business Process Automation, or BPA. Now let's analyze why Dipro chose to outsource in the first place. There were four main strategic drivers. The first one was a focus on core expertise. Wipro wanted to free up internal resources to focus entirely on their technical services. The second one was cost efficiency. Outsourcing allowed them to avoid the heavy overhead costs of hiring, training, and maintaining a full-time in-house accounting team. The third one was access to professional skills, leveraging the vendor's specialized software and financial knowledge. The last one, they wanted to offload repetitive low-end data entry tasks so their internal management could focus on strategic planning. However, the partnership encountered massive friction. What went wrong can be broken down into three critical failures. The first one, Wipro suffered from a severe lack of control and visibility. Because the work was done off-site, they could not monitor their financial data in real time. The second one, a major communication gap is formed, resulting in a failure to transfer a process-specific knowledge smoothly. The third one was a complete misalignment of goals. The vendor failed to realize that a government ministry required a much higher level of precision and strict deadline adherence. Consequently, PPA's reports were consistently late and filled with errors. If we look at the driver table for this case, these failures are exactly what drove Wipro to execute a turn-back strategy and insource their accounting functions. The intense pressure for regulatory compliance from the ministry meant that late reports were a massive risk to Wipro's funding and reputations. Therefore, the need for direct control and risk mitigation completely outweighed the convenience of outsourcing. And finally, let's look at the missing step in Wipro's initial decision-making process. The first one, Wipro skipped a rigorous vendor capability assessment. They did not audit whether BPA actually had experience handling government compliance or not. The second one, they failed to establish a clear and enforceable key performance indicator within their contract to guarantee strict turnaround times.
Now, let me bring everything together with a final judgment on the make or buy decision. Throughout this presentation, we have seen that both making and buying come with clear advantage and serious risks. So, what is the right answer? Here is the truth. There is no universal right answer, but after analyzing the factors, challenge, and the Wipro technology case, we can identify a clear pattern when making a decision. We need to bear in mind that the deciding factor is not only on cost, but also control. This is because if the component involve your company's intellectual property, trade secrets, or core technology, then you must make it internally. In the Wipro technology case, they outsourced their accounting to save money, but lose control over their financial reporting. Thus, when the vendor failed to meet ministry deadlines, Wipro had no choice but to bring everything back in-house. On the other hand, if the component is non-core, standardized, and widely available in the market, then buying is almost always the better choice. This is because you can avoid capital expenditure while stay flexible and focus on your resources on what you do the best. So, here is my final recommendation to any manager when facing a make or buy decision. Firstly, manager needs to identify whether the component is core to your competitive advantage. If it is, then it is better to make it. If not, then consider buying it. Secondly, before buying, managers must actively assess the potential supplier to ensure its reliability and efficiency. This is important as it may affect the company's operation directly, even if the fault lies with the supplier. Third, if the company has idle capacity, then the managers need to carefully calculate the incremental cost. This is because making may be cheaper than you think. Last but not least, managers need to also build an exit strategy or backup plan because this is essential, especially when the company faces unforeseen circumstances that may force them to switch to another decision. In conclusion, the make or buy decision is not just an accounting calculation, but it is also a strategic choice that defines what kind of company you want to be. Do you want to control everything or do you want to focus on the core operation and partner with others? That's all from us. Thank you.